Every huge company you can think of, it all started with just a simple idea. But how does an idea actually get the money it needs to become the next big thing? Well, today, we're going to follow that money trail and find out exactly how it works. Okay, let's get into it. So, let's put you in the founder's shoes. You've got this brilliant idea, right? But ideas, they need fuel. They need capital to pay for, well, everything, from office space to engineers to marketing. Finding that capital, that's a journey. And today, we're going to lay out the map.
And here it is. This is our map for today, the financing life cycle. As you can see, a company doesn't just get one big check and call it a day. Nope. It needs different kinds of funding at different stages of its life. It all starts with that initial seed money, usually from friends and family. From there, you meet angel investors. Then come the big leagues, the venture capital rounds, Series A, B, and C. After that, you might see something called mezzanine financing. Think of it as a bridge for mature companies getting ready for the final stage, going public in an IPO.
So let's start at the very beginning. It's a place that a lot of people in the industry call the Valley of Death. And honestly, it's the first and maybe the toughest hurdle for any new company. It is a total make-or-break moment. This chart really shows you the whole journey. You can see revenue starting at zero and hopefully curving way up. But pay attention to those dotted boxes. Those are the funding gaps. That first one, in the first few years, that's when companies are just burning through cash to get off the ground. And if you survive that, you'll eventually face a second valley of death when you try to scale up. And this is the stark reality of it all. Most new businesses just don't make it across that first valley. They run out of money long before they can build their product, find customers, and actually start making any money. The stakes really couldn't be any higher. So how do you survive? How do you possibly find that oasis in the middle of the desert? Well, for most founders, the very first answer is something called bootstrapping. It's all about looking inward for resources before you ever look outward for help. And that's the key point right there. Bootstrapping means you're not trying to convince professional investors just yet. You're funding the business with your own money or maybe money from people who believe in you personally, like your friends and family. It is the ultimate form of self-reliance. And this chart shows you exactly where that bootstrap money comes from. Look at that. A whopping 90% of founders use their own personal savings. After that, it's credit cards and personal loans. This just highlights the immense personal risk and the incredible belief that entrepreneurs pour into their ideas right from day one. All right, so once you've bootstrapped your way to a working prototype, or maybe you've got some early customers, you're finally ready for the next stage, meeting your first professional investors. These are the angels. So who are these angels? Well, they're wealthy individuals who invest their own money into promising young companies. In exchange for that cash, they take an equity stake, which just means they own a small piece of the company. They're not just betting on the idea, they're betting on the founder. Angels play such a critical role. They jump in with capital during that super high-risk period, those first 3 years or so, and they bridge the gap to the next stage of funding. But it's almost always more than just money. They bring experience, they bring mentorship to help the company find its footing and reach what's called cash flow break-even. That's the point where the money coming in finally covers the money going out. And let me tell you, that is a huge milestone. Okay, so you've survived the valley. You've found an angel investor. Now it's time to scale the mountain. And to do that, you're going to need a completely different kind of fuel, venture capital. This is where things get really big, really fast. Venture capital, or VC for short, is funding that's specifically for companies that have already proven their concept and are now ready for explosive growth. VCs aren't just looking for a stable little business. They are hunting for the next industry giant. So, what's the real difference between an angel and a VC? This slide breaks it down perfectly. Angels invest their own personal money, and they do it in the super early stages. VCs, on the other hand, manage a massive fund of other people's money, and they invest much, much larger amounts in companies that are already on a serious growth path. And because the stakes are so much higher, VCs are usually way more involved, often taking a seat on the board to help steer the company's strategy. Now, VC funding isn't a one-and-done deal. It comes in stages, or rounds. Series A is all about proving you have a repeatable business model and scaling it. Series B is for building out the team and expanding your market. And Series C, that's often the last major push to just accelerate growth and get the company ready for the big finale, like an IPO. But VCs and angels, they aren't the only ones on this mountain. There's another really important player you should know about, large, established corporations that are also looking to invest in the next big thing. So you might be wondering, why would a huge corporation invest in a tiny startup? Well, it's all about strategy. Sometimes it's defensive, a way to keep a close eye on new technology that could completely disrupt their industry. Other times, it's offensive, investing in a startup whose product makes their own products even better. Think of a big software company investing in a small, innovative plugin. It's also a pretty powerful way to keep entrepreneurial talent in-house. So we've climbed the mountain, we've navigated the valleys. What's at the summit? It's the exit. This is the moment that all those early investors, the angels, the VCs, even those corporate partners have been waiting for. This is their payday. And there are two main ways this exit happens. The first is an IPO, or initial public offering, which is when the company goes public and absolutely anyone can buy its shares on the stock market. The second path is an acquisition, where the startup is bought outright by a bigger company. Either way, this is the event that provides the financial return for every single person who took a risk along the way. So there you have it. From a simple idea through these valleys of death and all the way up a mountain of funding, the path from startup to exit is incredibly long and challenging, but it's also a clear one. The process is laid out. So now that you know the map, what will you build?